All right, we got about a minute and a half until we get things going for a special holiday edition of the stream. So appreciate you guys who are once again patiently waiting for the last second stream that we threw together. We'll get things going in just a minute. All right, that is the timer. Let me X this out. Here we go. Let's go camera one. We are live. First question from from TrueFX in the Twitch chat is, am I going to teach you how to make millions unless you have a large number to start with? Probably not. But we are going to try our best every single week to get nice, consistent compounding returns. And to those of you who are joining us today, hopefully this is the first step in that as we wrap up 2022 and get into 2023. We took last week off, so we've got a lot of good stuff to talk about on this stream. Again, appreciate everyone who's tuned in. And without further ado, let's jump into it. So let's go back to the normal presentation. Put me in the corner. There we are. Let's go. So last week was kind of I mean, really a roller coaster, to say the least. We have all these trades, which is definitely a little bit more activity than we typically have on a weekly basis. But a lot of it was strategic in the way we went about it. And at the end of the week, we underperformed the S&P 500 by about 0.19%, and that's just because it ran up a little bit at the end of the day. But maybe more significantly is the fact that we outperformed NASDAQ by 1.66%, which is contributing to our goal of long-term outperformance in the market, which we have been accomplishing in the 2.5 years that we've been tracking our trades. Right, we're outperforming NASDAQ by about 130% now, and the S&P 500 by 108% since July of 2020. But for those of you who are newly joining us, you might say, okay, well, how does that help me now? I guess maybe more recently in 2022, as we come into the final year or final week of the year, we have a significant lead over the S&P 500 and NASDAQ. So I mean, really disaster could strike, and we're still going to accomplish our goal of outperforming the major indices on the year. But we'll save some of that 2023 recap stuff for next week because we still, again, have 1 week to go. And I think maybe better to reflect on 2022 once we finally close out the year. But last week, we could have lost a lot more. We could have made a little more, but, as is typical, we ended up right in the middle. We took about a $487 hit, which is whatever. But if we pull up the chart, we look at the S&P 500 via SPX right here. What we're going to see is a very, very volatile week, right? We peaked at almost 3,900 level on Wednesday afternoon and then bottomed out, below 3,800, which is a very, very significant intraday move, quite honestly. We were pushing negative 3% on the day at one point on Thursday, and that is very significant. But with that said, we survived the volatility and we're going to live to fight another day. So let's talk a little bit about how we fought that volatility. You'll notice by the end of the week, we got a little bit closer to being 100% fully cash secured in our positions, right? And the idea is we want to be very, very mindful whether or not you are or are not using margin, the quantity of positions, and I guess the size of those positions as well. Regardless of whether you're using margin, right? We do have this tab here, and this is something I'm probably going to take out for the 2023 tracker. But we always want to track things based on how large of a percent of our account they are on a fully cash secured basis so that if, shit hits the fan, so to speak, and we get assigned on all of our positions, we want to make sure that we're able to afford that so we can combat a potential disaster in the market. If we see that our account is like 200 or 300% fully cash secured and the market starts moving against us, that's going to be a pretty big problem and one that we try our best to avoid. So it's always important to be mindful of this number. Now, we did not start the week at 83% fully cash secured, and I think we got up to maybe 90-ish at the peak, maybe a tad beyond that. But let's talk about how some of these positions progressed, right? With MSOS, this is one we actually only ended up losing about $470 on it on the week, and if we type in MSOS right there, what we'll see is the fact that it went from 9 to 650, at the low point, and we really didn't lose that much money. In fact, had we held on to these 7.5 strike puts, we probably would have made money on it, but annoying. Question from Greg in the YouTube chat. He's been building a similar tracker. Any chance we have a Patreon group? We do not have a Patreon group. The closest thing we've got to that is our Discord server right here, which is where we, live discuss all of our trades, announce them as they're made. We have our discussion during the week, and that is that. You can go to hourglass-trader.com. Let me pull it up right here and click right there, join our Discord chat room, and that should give you the link right to the chat room, and you just accept the invite. But getting back to where we were, pulling that back off the screen. I don't know where it just went. There it is, struggling along here. Give me 2 seconds. All right, back to where we were. But MSOS, the great part about this trade was even though it kind of went poorly, and let me double check and make sure that OBS is still working and the stream's still good. Okay, perfect. Yeah, so what we were worried about here is the fact that it was going to keep going down, and we want to avoid big losses, right? It's okay if you lose money. We're going to win a lot with this strategy. We're going to win a lot. We have a very high success rate. But the other fact of the matter is that we're not going to have some big like $10,000 gain in one trade. Like the types of trades that we like to pursue are the smarter, safer, more attainable gains and compound those gains. And that's really visible through our performance since inception, right? We don't have any weeks where we're just shooting up through the roof and have like some 50% return. We just want to slowly build. We want to use the cushions that the option premium we sell give us. And we want to make smart trades every single week. And I think this is the result of that. We've had a couple big downfalls. And again, probably better to talk about those in more of a 2023 recap type forum. But, point being, what we're doing, we're not trying to knock it out of the park. And if we do have a loser like we had with MSOS, do what we can, roll down, play defense. Sometimes you have to play defense to a point where you take profit out of the window. But in doing so, you protect yourself a little bit further from that downside. And that's what we did there. DraftKings is another one where we lost a little bit of cash last week. We lost about $12.40 from the shares, but we were able to pick up $7.20 from what we sold from covered calls. And that's exactly why we sell covered calls, right? And ended up only losing $5.20 right there. So right off the bat, MSOS, DraftKings, those things dropped on us, decently significantly over the past week. But then we've got some other ones like ASTS, FTCH, right? Those picked up $450. And while through DraftKings and MSOS, we were down $990 on the week, you bring in ASTS, you bring in FTCH, all of a sudden, you're only down $540. AMC also dipped a good bit, but, it's another one of those losers. We lost $280. But again, those aren't the only trades we have in play, right? We want to diversify the portfolio when you have a bunch of base hits that add up to performing very, very well for us. But, I can go down these lists to death, but point being is we had some good ones, we had some bad ones. Nothing was super, super bad. I think maybe the worst thing was Stitch Fix. We lost $500 on that, and that was kind of an afterthought of a position. It wasn't one that I was terribly, had a huge conviction on. Question from Jeff in the YouTube chat. Good question here. Is there a reason why we took assignment for DraftKings as opposed to rolling the puts forward? And, the big secret, so to speak, with option selling is rolling puts and selling covered calls are kind of the same thing, right? Let's say, for an example, just ignoring DraftKings, if you had a stock that was trading at $10 a share, and let's say you had sold 10 strike puts on it and it goes down to like $9.50, right? You've got two options. You could roll your puts or you could take assignment. From a profit and loss perspective, if you took assignment at $9.50 and sold 10 strike covered calls, that's the exact same risk loss, like profit loss outcomes as selling a 10 strike cash secured put. Reason being is the share appreciation for those shares that you take assignment of at 950 to walk up to 10 where you sold your covered call is accounted for in increased premium from those 10 strike cash secured puts being in the money. So really, the only time it's really a consideration is if one, there's more extrinsic value on the call or the put side, in which case you would want to play that side. Or two, if there's some sort of margin consideration where, it's less margin to hold cash secured puts as opposed to owning shares or vice versa. With DraftKings, it really wasn't one or the other. I think we were far enough in the money 2 weeks ago on these things, yeah, where it was pretty obvious we were going to be assigned. So we said, hey, let's maybe not waste a couple cents here by trying to roll these things and instead just accept assignment, sell calls, let the shares get assigned, and then roll into the week of 12-18 with covered calls. And what's interesting about these on DraftKings is the fact that, right, you'll see that we sold 11.5 strike calls. We started with 12.5, and this is another, I think, good example of how to play defense a little bit, right? We wanted to leave ourselves some upside, right? We had these things at 12-12. We lost a bit on them 2 weeks ago, so we want to leave some upside in case they decided to bounce for us. So we started with 12.5 strike calls, and the stock went down, so we said, okay, let's uncover these shares. Let's take $140 of profit, and let's try again. And then we rolled down to 12 strike calls because we get a little bit more, and this wasn't simultaneous. We got out of the 12.5 calls, it bounced back up a little bit, and then we got back onto the 12 calls to make sure, okay, let's make sure we at least get something here, right? And then it went back down, and what we did was say, okay, one final time, let's roll down to 11.5. Yes, if DraftKings shoots back above 11.5, we will have capped our gains. However, we want to make sure we get something just in case these shares drop. And right, the big thing, especially in 2022, that we want to keep in the back of our minds is that things can always, always, always get worse in the market. And they kind of did, right? We lost $1,200 on the shares, and had we not sold these covered calls, that would have been a $1,200 loss. Luckily, we were able to recoup $720 of premium on those. And a really interesting note about these 11.5 strike covered calls that we sold is let's take a look at where DraftKings finished on Friday. And the answer is 1153. However, what do we know about option assignments? And it's that technically you have until like 5:30 p.m. Eastern time to get your assignments in. And what you'll see sometimes is that some brokers exercise based on the price at the bell, and then some do it based on that price at 5:30. If we really go to the one-day view and see what DraftKings was doing, right, here's 1150. This is where our strike was. Anything over that, hypothetically, we would get assigned. And then right at the bell, it gets to 1153. So we're thinking, okay, we're going to get assigned. But by 5:30, guess what? It's down to 1144. So we're in a position where it would be stupid for someone to assign us on these. But with that said, let me go pull up the screenshot that I had a second ago. What's very, very interesting about this DraftKings position, if I scroll back down, find this screenshot, is we got this email from TD Ameritrade on Saturday morning letting us know that we had actually been assigned, meaning that even though DraftKings had dropped below 1150 after hours, because it was 1153 at the bell, some brokers for our counterparty, meaning the party that purchased the option from us, exercised that option. What's interesting is we had 20 of these, but only 17 got assigned. So what does that mean for us? I guess in short, backing up and taking a little larger picture look at this, it's great, right? Because we have these shares, which at the bell we're trading for 1140. We just got to sell these to somebody for 1150. So we kind of made like $200 from that assignment. But we still have 300 shares left. So really, we want to get back to that 20-ish size position, right? We still have the same idea on DraftKings that we think is going to happen where, look, on the 180-day, we've got RSI low. We've got a really nice support point here at 11, just above 11. So we want to get a little more bullish here because every time this RSI has kind of gotten down into this blue level, we've seen a somewhat material jump back in the stock. So we want to leave some upside. So as far as planning for next week, let me pull this tab back over again. What you'll see is we planned on having 2,000 shares because we didn't expect to still have these. But we're probably just going to, we have 300 shares still. We're probably going to walk our way up, either dump the shares at open and then just sell 20 cash secured puts at like 12 strikes so we could play it back up to that 12 level. Or we'll just buy more shares and sell more covered calls. We'll kind of see how it looks when the market opens tomorrow morning. But that was something interesting worth talking about last week. And then let's talk a little bit about scaling into positions, right? We talk about how when we enter into a week, we don't always have this full size position. We love the idea of starting with the 50% position size, targeting a 2% or greater return on risk, because a 50%, I guess maybe backing up a little bit, we want to get 1% per week. I think that's a very good target. It's an attainable goal in the sense that we're not going to get it every week, but it is realistic to target that every week. We understand that we're not going to hit it every week. That's just a reality of trading in the market. But in targeting that 1% goal, you could either put your entire position into something that offers a 1% return, or you could put a half-size position into something that offers a 2% return, which is what we have opted to do in several of these situations. So for example, these Roblox 26.5 strike puts, we sold these for 68 cents. Roblox, let's kind of walk through the 5-day action on this. Talk about how we manage this, because for all the bad ones that we talk about like MSOS or DraftKings, Roblox has actually been great for us, right? We made 330 off it this week. 2 weeks ago, we made another 300, so up to like 640 bucks of profit off of it, just off a roughly like 2-week basis. And I think this upcoming week we're in line for another 385 of profit if it stays above 26, and that's looking good so far. But let's talk about how we managed that and scaled it. So the first thing that we did, and I thought was a fantastic thing, learning from our mistakes, not doing something stupid twice, is the fact that we started and took profit. If we scroll up here a little bit, we took profit on the 26.5 strike put, right? Here's Monday, here's Tuesday, and Roblox had jumped up to 28 plus. And we know that, look, anything here or above is max profit. But on a Tuesday morning, you have a half a day plus 3 more days. You have 3.5 more days to go in the market. You still have 70% of the week to go. And we're able to take like 70-ish% of max profit. That's a no-brainer. Because if we had kept these on the board, they would be this 34 number that we see right here. And in doing so, what it does is, 1, it locks in profit. 2, it frees up buying power. And that point is important because if the market falls back down, guess what? Like it did on Thursday morning, we could get back in the exact same position we were before. And we were actually able to do that for even more than we closed out for, pretty significantly so, right? We closed out for 15 cents and we got back in for 47. So in addition to this 265, we now had the opportunity to make another like 250. And on Friday, it did drop back down a little bit at open, so we had to do what we had to do and just lock in a smaller profit. But in doing so, we were able to roll to next week and are now in a position where we can get $385 on that above 26. But this is a great example of why scaling in, starting smaller, taking profits is a great, great exercise, and is really gonna be something I think you're more thankful for more than you regret. Because if you regret it, it means the market keeps running, and if the market keeps running, you're making money during that week. So it's a good problem to have, so to speak. Amazon here, and I think this is a good one. We'll talk about Amazon, and then I think we'll talk about XSP as well, and then we'll move on to next week. Amazon has been a great example of a trade that we've been following for a couple weeks, and sometimes the way that we follow the HT wheel that we run can get a little bit complicated, but Amazon has been a much more stable stock. I think it's a decent value where it currently trades at, and above all else, it still offers decent premium. So it's been a good exercise in understanding how this works. And we've got this trade breakout tab here that I could zoom in a little bit further on so we see what's going on. But you'll notice that we started playing this on December the 15th, 2022. And if we pull this up and go to the 10-day chart, because I think that's within the last 10 days, we'll go 20-day. December 15th is right here. And you'll notice it was trading at about 90-ish a share. And I think officially we started the trade when Amazon was trading at 90 a share. We thought that was a good price because it had fallen back down from these high 90s. To get it at 90 seemed like a good idea. However, as is often the case in the market, what we always want to keep in the back of our minds is that things can always get worse. And they did for Amazon. But thanks to our more cautious approach, right, we started with an 89 strike put for $1.22. That in of itself is about a 1.5% ROR. And you might say, HT, that's not exactly the 2% ROR in a half-size position that you normally talk about. However, I'm willing to take something like a 1.5-ish% return when you've got a stock like Amazon, which is going to be much more stable than something like a Firm or like a DraftKings. So you do want to balance the risk to reward and definitely consider how stable the stock itself actually is. So we got in there, and again, our initial break-even price is 89 minus $1.22, so it was an 87.78 break-even price off the bat. From there, we lost a little money on the initial one, but what do you do when you lose money on a put? You just kick it into next week, right? These individual options that we sell have fixed expiries, but we could roll infinitely until the heat death of the universe. We can roll these options. So we rolled it, same exact strike, and we did it for $1.08 credit, meaning we closed it for $1.80 and we sold the new one for $1.08 more for $2.88. This accomplishes two things when we roll for a credit, right? We always love rolling for a credit. The first thing is that it increases actually our max profit. Our max profit before was 122, and since we rolled for a 108 credit, that 122 profit is now increased by 108, the credit we received. And the second thing it does, again, first is it raises the profit. The second thing that it does is lower our break-even price by the credit. So our break-even price went from 87.78 to 86.7. So we now have a lower break-even price heading into December 23rd. And we also have more potential profit on the overall trade on a really nice stock. Fantastic. And again, remember, we're still in a half-sized position. So we go back to the chart. What happens to Amazon? It keeps bleeding out before that 23rd expiry, right? So what do we do? And I think we did it on the 19th here when you see this big slide from 88 to about 85-ish, right? We knew that our break-even was 86.7. The stock got below that. So how do we do? What do? We take advantage of the fact that we had a 50% position size, and we add another, which is this 84 strike put right here, and we did it for $1. And what's the great part about a position where you have a 50% position size and you double it? This dollar of credit that you get right here is a direct reduction to your cost basis. So we go from having an 86.7 cost basis to an 85.7 cost basis. And again, you'll notice the theme here. Day by day by day, just keep knocking this break-even price down. Amazon's a solid stock. Will it have slides and skids like we see on the last 20 days? Absolutely. But if we keep lowering our break-even price week after week after week, Amazon's not going to go down forever. So we stick with it. We have an 85.7 break-even price. This expires worthless. And we head into the next week with this 85.7 break-even price. So what do we do from there? And to me, the answer was, since Amazon's been beaten down like this, and if we go to like the 180-day chart, we see that RSI and Amazon's a little bit oversold, but not a ton. But still, look, I mean, this thing peaked at 158. It's in the mid-80s. I'm comfortable to be a little bit more bullish on this. And in line with that opinion, we did roll down from 89 to 87. Reason being is this gives us a little bit more extrinsic value. But to compensate for the fact that we rolled down from 89 to 87, we again opened another 84 strike put for just about the same exact credit. So we now sit here on last Friday after we locked this trade in, heading into December 30th with a break-even price 84.09, which should take this down to zero. Perfect. An 84.09 break-even price, right? So we started this trade on December 15th, right around here when the stock was trading at 90. Less than 10 days later, right? We started on December 15th. On December 23rd, 8 days later, we have an 84.09 break-even price on this trade. That gap right there between that level we started the trade at and where our current break-even price is very, very significant. And making progress like that just over 8 days is going to make you very, very profitable. And it's a very shaky market, right? We see the volatility here that Amazon has displayed on a 1-month basis. How do you fight that volatility? By just continuing to move that red line that represents our break-even price further and further down. So there you have it, right? We started with this trade at 89 about 10 days ago, where we could have made 122 bucks. We're now sitting here, and if it goes back up to 87, we're going to make 291 bucks, which is just under 3x the amount that we set out to make initially. And the best part is, if it gets to 87, objectively, the stock will have dropped 3.33% while we were in it. But we make enough money for the equivalent of a 116% annualized return. And to avoid being too clickbaity with that number, where does that come from? It comes from the fact that we had a 3.2% return on our capital over just a period of just over 2 weeks. So if you did that, I don't know why I'm missing the word here, but if you compounded that little 2-week period, there you go, of 3.23% returns over the entire year, that's what it give you, 116.45. And it's a great way, because I know sometimes it's frustrating to say, oh, we did all this work, we moved our break-even price, we scaled and we rolled, we did all this over a 10-day basis, and we only get 3%. But like 3% over a 10-day basis, that's a very significant return, and that helps demonstrate that to kind of keep you sane and keep you on the straight and narrow here. But again, great example of how Amazon is a steadier stock, but still offers decent premium, and we're able to use that HT wheel strategy, right? You've seen all of it. You saw a put get rolled, you saw us double down to increase our position size, and then you saw us roll it out again into the following week, all accomplishing the goal of starting a trade here and then getting our break-even price down here below where the stock currently sits, despite a sell-off in the market. So that's that one. And then the last one I want to talk about is XSP, where we had this strangle down here, the 381, 387 strangle, and we made 556 bucks off this. We have something very similar set up for next week, so I think it might just be easier to talk about what this is and why we think it's going to work really well for us next week. And conceptually, what is XSP? What is a strangle? Why are we doing this? What's going on? Let's talk about it. So first things first, we're set up to make $390 of profit on this. How will we make that $390? Enter XSP, the instrument that we're using this on. And this is the mini SPX index, right? You may know SPX as the S&P 500, but look, it's 3,844. That's a large number. If you wanted to sell an option on that, the notional and the amount of collateral you would need to secure that position is very, very large. So let's go to XSP, which instead of being 3,844 is 384.48. It is divided by 10. Sorry, just finished the holidays. Brain's not moving at full speed right now. But it's SPX divided by 10. Why is this great? Because it behaves the exact same way as SPX, right? It's tax advantaged. It's cash settled at 4 p.m. on the day of expiry. And the best part is you don't need as much collateral to open a position in it. So what position are we in, right? We're in a 377, 386 strangle, meaning we sold a 377 strike put, we sold a 386 strike call, and if XSP finishes next Friday between 377 and 386, we are going to hit max profit. So let's go to the chart and take a look at what that looks like. So 377 on the put side. It's a little too high. 377 right here. And then 386 on the call side. There we go. Okay, so let's go back and maybe do a 5-day chart so we can see a little bit more realistically. But look, last week was a very volatile week in the market. It peaked at 388, it got down to 376.45. That's a lot of movement. However, we're now in a position where as long as XSP finishes inside of these, we're going to hit max profit. And you may say, okay, like HT, I mean, if we look at the volatility on Thursday alone, that almost covers the entire range right there, and you'd be 100% correct. It kind of does. But one, Thursday was a pretty volatile day. And two, yes, our max profit is within these two red lines. However, we could zoom out a bit. We're still profitable inside of an even wider range. So what is that range that we're profitable within, right? Max profit's between here. Where's our range of profit? And the answer is these legs, both plus and minus this credit received, right? So on the high side, 386 plus 3.9 is essentially 390, which is up here. 377 minus 3.9 is essentially 373, which is down here. So when we take into account what our actual break-even price is on here, right? Not just our max gain level, which is right in here, but where we actually make money, which is between this top line and this low line, over a 4-day period, because the market's only trading Tuesday, Wednesday, Thursday, Friday this week, I think it becomes a much better value proposition. And the way that I'm managing this is going to be very, very similar to the way that we manage, some of our other positions and some of our SPX credit spreads that we've opened in the past, right? If it goes down on the downside, right, and it breaks down below 373, first things first, the 386 call that we sold, it's going to be worthless. So you pay a couple bucks to close that thing out. And then what you'll do is you'll double down on the 377. So if it goes down to 373, you'll then sell like another 373. So you now have two of these cash secured puts, meaning your deltas are going to be a little bit more bullish. So if it goes down this low, we think RSI is going to bottom out. It's probably going to bounce, right? The market could go decently up or decently down from here, but we know in general it kind of trades a little bit like a sine wave along the way, and you see evidence of that. Is it just kind of a wavy pattern? Yes, the market has trended down a little bit over the last 10 days, but it's a little wavy, right? And especially over a 4-day period, it's tough to get too far outside of that. I caution trades like this with individual companies because obviously you could see an individual company go up, 50% in a day. But with something much larger and more diversified like the S&P 500 index, I don't think you quite carry that equivalent risk. So that's something that we're in on here. And the idea is it kind of hedges both ways, right? We want to hedge against the action of RSI. So if it runs down, we're hedged on that and we could scale in that way because our call is going to profit and we could get more puts. If it runs up, that's fantastic, right? Because while our calls are going to be in a little bit of hot water, the market running up is great for our overall portfolio. So we're already kind of inherently hedged in that manner because our portfolio is predominantly bullish deltas. So we're really happy with that potential as well. And honestly, that's the XSP strangle. We really haven't had to manage any of these yet, right? The one last week went great as we took home $556 on it. Not as much IV in the market this week, so we're only looking at about 390, but still a very significant amount of money as you try to build these base hits one on top of another and put your portfolio together as you work to, accomplish a really nice week. So let's talk about this nice week that we're trying to accomplish, right? We were relatively in line with the S&P 500. We crushed NASDAQ last week. How are we going to try to win this week? And I think we've got a very, very nice portfolio top to bottom. DraftKings here, we talked about that a little bit earlier. I mean, look, we like to talk about RSI as a technical indicator. We throw DraftKings in here, and for whatever reason, when I typed the letters, they didn't show up. Take two. There we go. I mean, this thing on a 10-day basis, you could already see how low this thing is trading. Implied volatility starting to tick back upwards. We zoom out a little bit to a 180-day view. I love this $11 level on DraftKings, right? If we extend this to the left, why do we like this so much? We see 1, 2, 3, 4, 5 bounces off this, and we're down here for a 6th time. We're hitting that support level at the same time that RSI on a 180-day basis is getting very, very low over here. And again, when RSI gets into the low on DraftKings, we see blue here, shoots right back up. Gets into the blue here, temporarily shoots back up a little bit right there, and longer term does close higher within the next couple weeks. We see some blue here, right? This thing goes from 14 to like 17. See some blue here. We go from 12 to 17 before it goes back down again. But point being, yes, this thing is susceptible to some large slides. We've seen that as we've kind of ridden it down from 15.5 to 11.39. But point being, from a technical analysis perspective, it looks fantastic, both hitting support right now with the low RSI. So what we want to do is take these shares that we have and we want to sell some 12 strike calls, which are going to get you a little bit of premium. We want to play it a little bit up at a time. 17 to 18 cents isn't a ton, quite frankly, but here's the deal. If it goes up past 12.15 or 12.16, 12.17 and selling these is a bad idea and we get up into this range, that's a good problem to have because it means we're going to take home a little bit over $1,500, I think, on DraftKings this coming week. And then we could roll those calls even higher and just move that strike higher and higher and higher as we try to capture more share appreciation if it decides to rip back upwards, which is what we're hoping for. But happy with that one. ASTS and FTCH, these were just rolled from the prior week, right? These things have been hanging around for about a week or so. I mean, ASTS and FTCH together brought us $450 just by hanging around that 4 level. And then this week, they'll bring us 200 and 340 more. So on a 2-week basis, if these things just kind of stay near 4, that'll be $1,000 of profit for us. We could take a look at the charts right here. FTCH, this one has fallen off the face of the earth, but it's starting to base a bit around this 4 level. RSI lowered a little bit here, but what we love about FTCH is even though they had not the best earnings right here, which is why you see it kind of fall off the face of the earth, we've got some price targets that are over 100% higher than where the stock currently sits. So we're going to trust that those analysts aren't completely talking out of their ass, but sometimes they very well may be. But sticking with that one, at least at the 4 level, right? 4 seems like a fine place to get in here. ASTS also hanging out around 4. And if we get assigned on those, we get assigned on those objectively over a 180-day period. It's a very, very nice place to be assigned at. Roblox. This is one from last week, and Roblox has been working fantastically for us. We consider 10 contracts to be a full-sized position here. We start with 5. We'll double down if it goes below our weekly break-even price, right? And what's our weekly break-even? It's 26 minus the 77 cents of premium we get. meaning our weekly break even on Roblox is going to be 25.23. So if we pop over to the Roblox chart, take a look maybe over the last 20-ish days or so, we know that, let's get these lines out of here. Let's go to 5-day basis. We know that 25.23 is going to be our break-even price here. So long as Roblox stays above this red line right here, we are going to be making money on the upcoming week. And if it stays above 26, which is right here, we're going to be taking home our max profit, the grand prize on that one of 385 bucks. And combined with what Roblox has done last week for us, where we took home about 350, and the week before where we took home another 300 bucks, that would be $1,000 of profit on Roblox on a 3-week basis. And what's crazy about that is look how this stock has done on a 3-week basis, right? The answer, not very well. So that is something that we definitely want to keep an eye on. It's done very well for us. And despite the fact that the stock has dropped this much over the last month, and we're looking at potentially making $1,000 on it if it just stays above here, I think is a really nice testament to our option selling strategy, just demonstrating the flexibility and how adequately it can withstand some of the volatility in the market. Delta Airlines here at 32 strike put. This one, we love the 32.5 level on Delta. We've been talking about that one in the Discord server. 32.5 falls right here. And look, it's just been bouncing off, if not exactly that, slightly above that or slightly below, but it's been a very strong level, even backing up to the 180 day here. We move this thing over to the left. Bounce here, right? We see it bounce around here. Anywhere around this 32-ish level, I'm perfectly happy with Delta. The great part about Delta is we've been playing historically. By historically, I mean the last couple of weeks. Last week was a 32.5 strike. I think the week before that, we also played a 32.5 strike. That's $390 of profit from those two. And this coming week, we're going to hit 250 just if it stays above 32, which is a 50-cent lower strike that we've been playing in the past. Now, what I do think is maybe a little interesting with this one is there's been a lot of news this weekend about airline cancellations. I think Southwest is a particularly large offender. I think I read like 60-ish% of their flights today were canceled, which is insane in relation to some of those rolling blackouts and power restrictions with the cold and winter storms around the country. So I don't know exactly how that may or may not affect Delta stock, but the great part about this is, look, we sold a 32 strike for 50 cents, meaning that so long as Delta stays above 31.5, this thing could drop 5% this week and we still would make money. Which is like, I love those sentences because it just simplifies exactly what we're going for with this type of strategy, right? We love this break-even tracker because as long as the stock doesn't drop by this much that we have demonstrated here, we're going to make money. So long as Unity doesn't drop by 7.5% this coming week, we're going to make money on it. Amazon, 2.5%, Affirm, 5.3%, TQQ, 4.04%, but like that's the idea, right? We set ourselves up with these cushions, and if they get breached, they get breached, and we always have plan B ready to go. Let's finish out this list for what we have for the coming week. We've got Amazon, which we talked about a little bit earlier. We love the combo of the 86 in the money cash secured put and the 84 cash secured put just out of the money. At a base level, meaning if Amazon doesn't go up or down a single cent and finishes Friday exactly where it is today, we're going to be taking home 226 bucks on that position. Affirm, I would have liked to get a little bit more aggressive on this one, but the price action of it honestly scares me. It feels comparatively a little bit weak to the overall S&P, but this is just like, if you look at the RSI on like a 1-year basis, it's in the basement right now. And 9.19 is such a decent price to have the stock at, I think, despite how much selling there is. The only thing that scares me a little bit for the coming week, hey, Just Arky Channel Sui. I probably pronounced that again terribly. Thanks for the follow. And it looks like you are advertising in the chat. All right, maybe not. Anyways, with the firm, it feels like it's a little bit weak relative to the S&P 500. I mean, that's obvious, right? Because the S&P 500 isn't down like 70% in the last 3 months. But especially the price action over the last few days, right? Even some of these growth stocks where we understand that they'll have these big spikes downward, we kind of stick with the downward skids because we trust that the runs back upwards will be, equally volatile and, equally beneficial. But I've really started to lose that feeling a little bit, right? And it's tough because we've struggled in the past being like, oh my gosh, this thing's got crushed and we got out at like the bottom. And it's one of those things that you regret a lot. But at the same time, smart money, don't regret staying in a stupid position. But it's tough not to regret it. But we want to stay with it a little bit, right? So what I've done is set myself up with these 9 strike puts. 10 of the 9 strike puts, 5 of the 9.5 strike puts. So at base level, right, if it doesn't go up or down from here, we're going to make $575 on Affirm. If it bounces back up to 9.5, that number is going to go a little higher if this updates for me. Come on, come on, come on. There we go, 320. We're going to make $730 overall if it bounces. So we'll get something nice that's not exactly going to make back the losses we've had on Affirm over the past month or so, because it's dropped like 30-40%. That's pretty significant. But it's a start, right? You know, it takes you 3 weeks or so to dig a hole like that. You're not going to get out of it in one, and I think trying to get out of it in 1 week like that is bad news, and it's going to result in you probably regretting what you tried to do to get out of it. TQQQ, we took some shares manually. We manually signed those on Friday. We got those at a 17.25 basis. We sold an 18 strike call. I mean, just very similar idea across the entirety of the market, right? We've seen TQQQ peak at 25.1 on the morning of December 13. Bottom out at 1658-ish, but look, at this point, it's like something's got to give a little bit. We go to the 180 day. This seems to be a decentish level where TQQQ has bounced in the past, although I would caution you, with the leveraged ETF like this, support and resistance are not really as applicable because these are just purely leveraged based off of something like QQQ, where you might want to look and say, okay, looks like support may be slightly lower here. Support for TQQQ is much more based on QQQ, the non-leveraged Ultra Pro ETF. But with that said, look, where this is, where RSI is, we're happy to get a little more bullish on here. We want to play it back up to 18. And it's one of those things where if the market goes up, TQQQ is probably going to shatter the $18 level. And it's one of those things where you might say, oh, why did we sell these 18 strike covered calls? You know, we could have made so much more money. But if it goes to 18, how much money are we making on this thing next week? We're making at least $1,000. So, good problem to have, right? Moving further down here, Lemonade. This was one that we kind of got a little bit cute with at the back end of last week when we sold 10 of these 14.5 strike puts for 22 cents. Again, I don't think this is the greatest company in the world, and I always hesitate when we have things like that, but from an RSI perspective, it seems to be at a great price. It historically had some support at 17, where it broke through and is now trying to find some new support. But as it finds that support, option premium, quite frankly, looks pretty decent, right? We've seen some pretty sharp drops on this thing because it's a lower volume stock, and you'll definitely see that when you look at the option chain. But we snuck in last week, right, with some 14.5 strike puts for 22 cents a premium, meaning our break-even price would be 14.28. And it closed above that. We were actually able to close out for profit of 120. But we said, you know what? We were willing to hit it last week at 14.5. Why don't we jump right back in again this week and hit it for 14, a 50-cent lower strike, even better premium, meaning we have a 13.70 break-even price over the next 5 days, which, you never, things can always get worse. You never want to say, oh, it's impossible for it to go this low, because in a literal sense, if it were impossible for it to go this low, that option would not have any premium. But with that said, this is where we sit. We'll bag $300 off that if it holds above 14 here, which I'm hoping it does a little bit. We've got ChargePoint. This is one that we've kind of sat on for a little bit. It's a former SPAC. So anytime you see these former SPACs trading above $10 a share, meaning the former net asset value of the SPAC that was holding it, it's easy to get a little bit nervous on those because we have historically seen a lot of SPACs crash and burn, right? But this one is a lot more legitimate of a company, right? ChargePoint was not one of those hastily rushed SPAC transactions. But we know that in the past, where has it gone down to? And this is why it's always such a good idea to just take a step back, look at the historical chart. What can we see? We saw that it bounced off of, 850-ish back in May. And guess where it just hit? It just hit that 850-ish level again. So what do? We start with the half-size position. And since we're pretty bullish on this due to the combination of really low RSI, and some further back, longer-term established support, we want to sell a cash secured put right at the money, right? We sold it right at 8.5. That'll bag us $300, and I think is about like Let me think about this. 4-ish% ROR. I could actually probably look right at this thing. 3.22% ROR, right? But it was, I think, 4 at the time we sold it because it's dropped down a little bit now that it rebounded, and we kind of got, at least at the end of the day on Friday, a little bit of that upward move that we're looking for. But again, sticks above 8.5, we're going to grab $300. Stays above 820, we're going to make money. Unity, same exact thing we've been doing pretty much every single week on this one. Unity has been a solid stock for us at this mid-20s level, so we're going right back to the well on that. And then we've got XSP, which we talked about. We're going to make 390 on that if it stays between that range that we highlighted earlier, and make money, period, if it stays in the middle of that even larger highlighted range. If I could click as fast as I could talk, boom. Here's our max profit range, and then here's our profit range, period, on XSP. So those types of, more index-related trades with XSP, which is based off of the S&P 500, definitely carry lower risk for those open-ended type of option selling strategies. And by open-ended, I mean like we're selling a naked call and a naked put technically on this. So you're not going to be susceptible to some like 30% move in a day on that. So a little bit less risk, but you can still take advantage of selling those things open-ended. But all in all together, right? It walks down to what would be a $4,018 profit for this coming week, which is, again, it's only a 4-day week in the market, so that'd be $1,000 of profit a day. And again, this is kind of the more quote-unquote conservative look at it, because this is how much money we would make if the market neither went up nor went down, right? If every single stock traded on Friday afternoon at the price that it currently is right now, we would make this $4,000 profit that we have outlined, and that's a 2.34% return in relation to our account. Faux Life 82, thanks for the follow, man. Welcome aboard. But this is exactly the type of thing, right? This is our bread and butter. This is what we like to do. We like to set ourselves up with some really nice potential profit for the week. And what you'll notice is so important. While we're taking home a potential profit of $4,000 if things just trade completely flat. And again, if they go up, we'll make more than this. But even if they just trade flat, none of these individual trades take home more than $500. In fact, the largest one here is $410 from Affirm. So it's not so much us putting all of our eggs into one basket and trying to knock it out of the park. Those of you who have been watching the stream and follow along, I'm sure, are sick to death of hearing me say this. But put together base hits, get the runners on base. Circle the wagons, knock them in. But adding up 200, 200, 200, 200, 200 is so much better than taking one shot at 1,000. It gives your portfolio diversity and just really helps you with that plan B if we ever do have to put that into play if trades start to move against us. So that's what we've got. And we can also play the really fun game of, hey, what would we make if the market actually moved up? Because, right, this 4,000 number is what we like to consider base profit, quote unquote. If the market moved in our favor, right, if DraftKings goes up to 12, these expire worthless. Amazon recovers and expires worthless. What did I type that was wrong? It didn't like something I just did. Amazon expires worthless. TQQ goes back up to this 18 number. Affirm gets back up to 9.5. All of a sudden, we're pushing $6,000 of profit on a short week. And again, these aren't big upward moves, right? This is only DraftKings going up 50 cents. This is only TQQQ going up 75 cents. So these aren't big moves to get from a 4,000 profit level to a 6,000 profit level on the week. And again, just a 4-day week. And the point of that exercise is to demonstrate that we're not necessarily making money by getting market movement in our favor. The great part about this is knowing this base profit level, because we talk a little bit about the upside and how we can get to $6,000, but at the same time, we always want to keep that downside risk in the back of our minds, right? What happens if it goes down? Our base profit level being $4,018 means essentially we hold these positions with like a $4,000 cushion. So we could lose $4,000-ish worth of our core positions, meaning the market drops, decently significantly to get us back to zero there. But again, we're back to zero. The market drops and we'll stay dead flat. Of course, there are weeks where it could go down and we'll drop down even further. It's been a few weeks since that's happened to us. You have to go all the way back to... I'm not going to keep scrolling, but you have to go pretty far back to find a red week where we didn't outperform. I guess technically last week we underperformed the S&P by 0.19%. But to have a significant departure where the market goes down and we go much further down, you've got to go back pretty far. And the reason being is exactly what we laid out right here, right? We've got like a $4,000 cushion to help cushion the fall. And I may have said cushion too many times there, but simply put, here's our break-even tracker. Each stock we have right here is a stock that we're individually holding in our portfolio. We've got the break-even price in column O that we're heading into this week with, and here is the all-important cushion, meaning each of these stocks can drop this amount before we start to lose a single cent on the trade. Like for example, Roblox can drop like 5% and go down to like 25.5 for example this week. We'd still make 135 bucks on it. We'd still make money even if it went down, which is great. But of course, it could go down to like 24 and all of a sudden we've lost 615, but that's a pretty significant drop in 1 week. That's like a 10% plus drop, which again, not saying it couldn't happen, but that's why we start with half-size positions. So if something like that does happen and the stock goes below our break-even price, we simply scale into a full-size position that accomplishes greater potential max profit, and it lowers our break-even price to help play defense in what is a volatile market. And again, like best case scenario with these things, it'll be like what happened to us with Roblox a couple weeks ago, right? Where we go in, we get out, the market goes back down, we get in, and then we scale in further, and then it comes back up. So even though Roblox went down during the week, we still took home like 310 bucks on it. So that's the idea behind scaling into these trades, and this is what we've got heading into the week. Now, we are 82.79% fully cash secured, and we mentioned this at the top of the stream, but it's never too important to keep reiterating. We don't want this number to get too high. And when the market's just like smooth sailing, we're probably not going to have this many positions, but RSI is a very important indicator for what we are going for here. And I think futures actually just opened as I was speaking about 3 minutes ago. So let's take a peek at ES and look where it is. Look at that. Off the bat, we've already gapped up a little bit here. Right? It's up 0.36%. So that is very encouraging off the bat. It could potentially be a a green Tuesday. Hopefully we're beginning the front end of like that so-called Santa rally. We would love to see that. But yeah, definitely a good sign. So with that said, we want to take a look at the RSI of SPX, right, the S&P 500. If we look at it on a 180-day basis, which I think is one of the more helpful timeframes to look at it on, it's 44, which is slightly oversold. If we go back to a 1-year basis, it's 43, again, slightly oversold. And this is a place where we want to be scaling in decently, right? We've slid from the 4,100 level to like the 3,800-ish level. So we want to start scaling in so when it jumps back up, we have, well-positioned portfolio that can take advantage of that. Now, the flip side of that is when we're running up like earlier in December and later in November when the market was running a little bit hotter and RSI was higher, we wanted smaller positions. But I think 82.79% fully cash secured is a perfectly reasonable place to be, especially when you consider the recent action of the market. But with that RSI, I guess one quick point I want to make before signing off is the approach that we want to take a little bit in 2023. And we've got Market Watch right here. We've got RSI listed right here, right? You've got 40, where did it go? SPX, SPY. 43.3 RSI on SPY, meaning it's slightly oversold, meaning it's probably a good time to buy. However, there are 11 individual sectors of the S&P 500, right? And we've got them all built out right here along with their respective RSIs. We could talk a little bit about portfolio diversity, and I think a lot of people make the mistake, myself included, before really thinking about something like this, is just because you have different positions doesn't necessarily mean that you're diversified, right? Because a lot of stocks trade very similarly to one another. A great example of this was a situation this week where we're trading Affirm right now, right? And you can see that it has not had the greatest like month, year, whatever. I think whatever time frame you put on Affirm, it's not necessarily positive. But if you take a look at Affirm, you may have gone to our scanner and seen that something like UPST, which is Upstart, also offers good premium. But those are two companies that are in a very similar line of business. So you may have made the mistake of potentially adding Affirm and Upstart saying, okay, I've got two separate positions, I'm diversified. But let's look at these two charts. I mean, we could stack these things on top of each other, right? UPST, AFRM on a 20-day basis down here. I mean, these charts are almost the exact same, right? These are so similar, and I probably need to do something like this to better illustrate that. But these are basically the same chart. So point being here is you could be in two separate stocks but not necessarily be diversified. So don't make that tactical mistake of thinking that's the case. Backing up to the point I was originally trying to make is sometimes it's not even just between two stocks. Sometimes it's within an individual sector. For example, consumer discretionary, which is a lot of what we trade. A lot of what we trade is consumer discretionary. It's very, very oversold. So just because we have something like DraftKings and then something like Amazon, those are both kind of consumer discretionary stocks. You may not be as diversified as you thought you were because those are still within the same industry of the S&P 500. So basically, the idea that we're trying to put forward here, and I think we're going to, accomplish it with automation, the way that we've attacked a lot of different issues in our Discord server, is kind of pull together every single week or every single day like a chart historically of the RSI of the different sectors, and then when we run our scans, right, we have our basic scan where if we clear this, we've got the highest ROR puts in the market, which is a great resource. But as is typically the case, there's 544 of these in here. That's not very helpful, right? But we're going to want to intersect these with maybe by industry. If we go to information technology, we could scan by that sector. We could scan by other sectors, right? And if we segregate our scans based off sectors and are cognizant of what types of sectors we are investing in the market, that is going to be a much more effective way to diversify our portfolio than just making sure that the names of the tickers are different. So we've actually kind of been working on coding our own individual one to pull that all together. The idea is we're going to, one, pull together historical charts and like a quick report like this, which has by sector, RSI, and throw together the chart. And then two, have a script that also then runs all these scans. So instead of you sitting here and flipping through, okay, let's load in the scan here. Let's do all this, yada, yada, yada. Let's actually have all the information readily available, quickly pulled together, and that's what we're kind of the nice winter break project that I've been working on. So hopefully we'll have that. And yeah, faux life, great point. Sector rotation, so important when selling premiums, right? Because look, yes, it's very helpful to look at the RSI of the S&P 500, but taking that second step, looking a little bit deeper at the sectors and understanding what the trends are, I think is kind of that next step, towards having some nicer trades. Because I think at its core, our strategy is very sound, right? And we've demonstrated that. But we always want to ask ourselves, right? Because we've outperformed NASDAQ and the S&P 500 very, very significantly just from option selling. But we always want to ask ourselves, how can we be getting better? Because until we're making 1% every single week without ever losing, there's obviously things that we can improve on. And we do understand one of the realities of trading is the fact that we're not always going to make money. And we didn't make money this year unless something crazy happens this week. But what we did do was we outperformed the market. And honestly, that's our goal. We accomplished that this year. Because at the end of the day, look, if we can't outperform the market, what are we doing here? We're so much better, taking time to not stream and spend all this time doing research and taking these individual trades when we could have just bought and hold. But thankfully, over the past 1.5 years, we have accomplished that. So we're going to keep doing that, and in an effort to continue to widen this gap between us and the indices historically, that is what we're going to pursue. The next big thing I think for us is that, mindfulness of sector and finding and evaluating and entering into trades based on that. So I think that's about what we've got. I hope everyone had a pretty good holiday break. For whatever reason, Google Finance has decided to stop working on me as I do this. But base profit for this week is going to be $4,000. Very, very nice cushion, especially with 4 days to go in the market. We've already seen that the futures for the S&P 500 are up about 0.5% already. That's very, very encouraging. Let's flip back over here. Give me 2 seconds. Full cam. There we go. But again, thanks to everyone who's tuned in on short notice over the holiday break. Hopefully we could round out 2022 with a nice profitable week and then wipe the slate clean and do it all over again, right? We outperformed significantly in 2021. We outperformed again in 2022 unless, something absolutely insane happens. But we've got a pretty significant lead so far. But excited to wipe the slate clean again in 2023. Take what we've learned from the past 2.5 years since we've been doing this publicly, and then just put it all together and hopefully have another successful year in and against the overall market. If you want to join us in our Discord server, hourglass-trader.com. Again, free to join the Discord server and ask questions, right? The very first thing that we want to do is teach the strategies, right? You can learn all this for not a single cent, completely free. All of the YouTube videos are up there, free for you to view, and we're always happy to answer that because I guess maybe backing up a little bit, nice little HT story time before we sign off here. But going back to when we started our Discord server, it was really just me and a few people sharing some of these things because, you know, I was doing reasonably well and people wanted to hear about what I was doing, so I kind of threw that together. But more so, it's because there's some really, really bad information out there. And I think those of you who maybe have been following the news a little bit or have heard about Atlas Trading or like Mr. Zach Morris on Twitter or some of those people definitely know a little bit about that, where people are, you know, running these pump and dump schemes. And it's really tough because you have these naive investors naive but well-intentioned, right? You've got people who have their hard-earned money and they want to come into the market and they want to make money. Unfortunately, you have people on social media who are like, oh, we've made 10,000% in a month. I can turn 5 grand into 100 grand. And more often than not, I mean, almost all of the time, they're complete scams. So we want to be a good source of information, and that's why the videos, the free part of the Discord server, the chat room for asking questions is all free, so we can get you set up with a more safe, consistent, and profitable approach, right? We're not going for 100% in a week. We're putting these base hits together. I'd pull the screen back up if I could, but look, we're not going to make $10,000 on a trade, but we're going to add up smaller gains, and we're going to see the impact and effect over a longer term of compounding returns. But here comes the nice self-plug. If you want to go a little step beyond that, get access to our trades as we make them, along with the premium chat room, hourglass-trader.com. Sign up for HT Premium, and you'll be able to have access to that. You can get a week for free. Again, everyone's financial situation is completely different. Try it out. If it's not for you, it's not for you. No skin off my back, right? You know, everyone's situation is different. We're always happy to help any way we can. But until next time, thanks to everyone who's tuned in. Hope you guys had a happy holidays and hope it'll have a great new year as well, because I don't think we'll be on again in 2022. But until next time, this has been the Hourglass Trader, where as time passes, we make money. Hopefully next time we see you guys again in 2023, we will have more money in our account than we have right now. And that is all we can ask for. So again, thanks a ton to everyone who signed in, and we will see you then.